Hi, everyone. Welcome to our channel. My name is Tharmila Rajasingam. I'm a real estate agent in the Greater Toronto area. And I really want to take a moment to introduce Stephen Pitucci and Neal Winokur. They're both members of the Realty Tax.ca. And a couple of weeks ago, I had a true privilege to have both of them come into our private Zoom call with our agents and share a ton of information about tax season, accounting tips for real estate agent. And I thought this would be super useful for people, for yourself and all the agents that are watching and that follow our content to be hearing this information, because this is one of those information I've noticed talking to a lot of real estate agents that they're not aware of this. So today, Stephen and Neal, they're going to really break down all the information you need to make sure that you're prepped for tax season so that you're in turn keeping more of your money. So I'm going to give it straight to Stephen and Neal so they're able to share as much information they can with you. And go ahead and introduce yourself, Stephen, Neal, and take it from here.
Thank you, Tharmila, for the great introduction. So my name is Stephen Pitucci. Joining me is Neal Winokur. We are both partners of Realty Tax.ca. And basically, Realty Tax.ca is an accounting firm focused on real estate agents. I would say we're probably the only firm in Canada that's doing this now, where our focus is not only just people in real estate, but specifically realtors. So we'll talk more about what we do in a second. I'm just going to continue on here, just first explaining what is the deal. As I said, Realty Tax is a CPA firm. We deal exclusively with realtors for all tax, accounting, and bookkeeping services. For myself, I started online accounting back in 2018. So that's when I really started my own practice. I've always been working with small owner-managed business clients. And what's been my interest, or what have been my main endeavor throughout this whole time, has been transitioning clients from archaic accounting systems and paper general ledgers and all those like old ways of doing things into modern, advanced cloud-based technology. For Neal, which you'll hear from in a second, he started his online accounting business back in 2013, and he's passionate about helping his clients minimize tax. What's also interesting about Neal is that he is an author of a book. So he published The Grumpy Accountant, and this book exposes the insanity of our tax system, and it offers ideas on how to massively simplify it once and for all. You can check out grumpyaccountant.ca to learn more about the book. And just a quick disclaimer, of course, what we're going to present in this presentation is just for informational purposes. Always make sure you do consult a proper tax or legal professional for your own specific situation. And there's three main things that we're going to talk about today. First, we're going to talk about tax season preparation for sole proprietor realtors. Then we're going to talk about tax season preparation for PREC realtors. So PRECS is something that's still pretty new in Ontario, something that obviously is dealing with real estate agents we're well aware of, and we have clients that are in that space. So we're going to talk about that. And then we're going to end off with a tax tips refresher. And then we're going to end off with a tax tips refresher. Okay. Neal, did you want to take this away?
Okay, so we're going to start by talking about sole proprietors. We know that realtors can either be a sole proprietor or you can have a personal real estate corporation. So we're going to talk about both today, but right now, I just want to focus a little bit on sole proprietors. So as you probably know, sole proprietor, you really have to file one tax return, your personal tax return, that's your T1. Of course, you still have to file your HST return. So you have your T1 individual income tax return, and that will include your business income and expenses. And then you also file your HST return. Now, the CRA requires you as a self-employed individual in Canada to keep books and records, okay, for 6 years, that's part of the reason why I wrote The Grumpy Accountant, because it kind of, annoyed me and frustrated me, the compliance burden that's placed on small business owners, self-employed people in Canada. It's a bit too much, honestly, but that's the rule. So books and records, and we're going to talk about what does that mean exactly? What are books and records? Okay, but basically for sole proprietor, you have two things you have to keep track of. You have your revenue and your expenses. Now, if you actually look at what the T2125 statement is, T2125 statement, this is a statement that's included in your T1 personal tax return. And this is what you are obligated to fill out. Here's what it looks like. This is not a separate tax filing, but it's a separate statement within your personal tax return. And here, as you can see, you have to report your income. And that income will flow through right from your T4A slip. And then on the next page, you're going to have all your expenses. So this is really the fun part, because your income, you don't really have control over. The T4A, your brokerage gives you the T4A that shows your commission income. You have to agree to that. Whatever's on your T4A gets reported here. But here's where you get to claim all of your business expenses. And this is so important because your expenses reduces your income. Income minus expenses equals net income or profit. And that's what you pay tax on, the net income after you've claimed all your expenses. So you want to pay as low amount as tax as possible. So you want to claim all the valid expenses you're entitled to. And here you see the home office expense. This is how they calculate home office. And then on the last page, you'll see how we calculate the vehicle. Here you go, vehicle expenses, very important for realtors, because we know that realtors, all of our realtor clients are driving at least 90% of their mileage for business usage. So you obviously don't want to forget that. So we want to keep track of your revenue and your expenses. So revenue is actually pretty easy for you to keep track of because at the end of the year, your brokerage will give you a T4A slip, and they will also give you the detailed worksheet of the T4A, which will actually show every single commission you earned during the year. And you want to double check it, make sure it's correct, make sure it agrees to your own records. And then you have to ensure, this is very important, that what you report in your tax return agrees to the amount on the T4A slip, and also agrees to the HST return you file. Your revenue on your HST return should agree to what's on the T4A. This is very important because if you don't do this, if there's a mistake somewhere, the CRA will send you a naughty letter and from their matching program because they want everything to match up nicely, what's on the T-slip to what you report in the tax return, which kind of makes you wonder, well, why do I even have to file a tax return if the CRA already has the T4A slip? So that's a whole other question, and you can read about that in my book. So that's for revenue, okay, T4A. Now expenses, this is where it gets a bit complicated because you actually have to keep every single receipt for every single business expense you incur, and you have to keep it for the past 6 tax years, okay? So this is not an easy task. And there's a lot of apps out there that can help you keep your receipts and scanning your receipts, and we're going to talk about that. And we also have a link here, I think we're going to pull it up, which is a list of all the expenses. This is right on their website, Realty Tax.ca, and you could download this PDF for free and keep it as a resource. And this list of expenses applies whether you're sole proprietor, whether you're in their PREC, but this is what you want to be looking out for. And if you haven't started doing bookkeeping right now, this is being recorded on March 1st, 2022. So if you haven't yet started doing any bookkeeping and recording your expenses for 2021, I would start right now. I would just pause this video that you're watching, and I would just start bookkeeping right now. Do not wait, because your due date is June 15th. You have to file your personal tax return and HST return by June 15th, but you have to pay your tax owing and HST by April 30th if you haven't already paid installments throughout the year. So we're March 1st, April 30th, 2 months away. This deadline is fast approaching. And I know that the spring market, now is the time when realtors get really busy. So if you haven't started doing this earlier, I would start right now. And it's important, obviously, to have a system throughout the year where you're not waiting until the end of the year, but we'll talk about that later as well.
So now I'm going to talk about PREC realtors. And there's a couple key things that you need to be thinking about if you do have a PREC. And just to introduce the concept, PREC is a personal real estate corporation. So this is something that you would have already had to set up before you do your tax filings, of course. But if you are watching this presentation and you happen to have a PREC, a couple things you need to keep in mind. Firstly, ensure your books for the year is 100% complete. Whether you're doing your own return yourself or you're giving your information to your accountant, they're going to want the bookkeeping either done or they're going to come back to you saying, please finish the bookkeeping. So what does bookkeeping mean? It's basically tracking every single transaction going through your bank account. You can use tools like what we use in our firm called QuickBooks Online and Dext, or you could essentially do it on Excel spreadsheet. But regardless which way you're doing it, you got to have bank reconciliations done along with credit card reconciliations done. Second thing to keep in mind if you're preparing for tax season, if having a PREC, is you got to figure out how much money did you draw from the corporation during the year. The reason why is that for tax purposes, you neither need to report this either as a salary or a dividend, which those two are either filed, like the due dates for those are February 28th. So essentially yesterday, the due dates for those slips needed to have been filed. Or the other option is you got to treat it like a shareholder loan. But of course, that does have tax implications, right? So that's the second point. Third point too is, technically speaking, this is more for something to think of going forward, because if you haven't done this, you're kind of already a bit behind, but you should be doing tax planning, right? If you are, let's say, entering 2022, and let's just say you set up your PREC 2021, yes, you got to deal now with all the compliance work for 2021, but 2022, you may want to have a conversation with a tax professional to discuss, like, how much should you be drawing from your corporation and what's the tax impact? Should you show it as a salary or a dividend? Like, these are very important questions, and it's very important that you do speak to accountants like us, or a lawyer or another tax professional who can give you more guidance on that. Okay. The thing I also want to mention regarding for PREC realtors, the reason why I specifically talked about needing bank reconciliations done is that for tax purposes, you need to basically produce a balance sheet and an income statement. So if you, let's say in the past, have always done your tax return yourself, or you went to another accountant as a sole proprietor, you would have only needed to fill out the income statement. That's what Neal was talking about. That's what Neal was talking about before, about needing your income and expenses. But fine, that makes your income statement. But if you have a corporation, you also need to produce this balance sheet. The only way you can properly produce a balance sheet is to have basically tracking everything going in and out of that corporate bank account and categorizing that appropriately and reconciling that to actual bank and credit card statements. So that's why I brought that up earlier. Some important dates to mention, and this is assuming that you decide to have a December 31st year-end date for your corporation or PREC. Payroll tax source deductions were due January 15th. T4 and T5, so that's if you're doing a salary or dividend, those were due essentially yesterday, February 28th. If you have HST payable along with the HST return for the PREC, that is due March 31st. And keep in mind, having a PREC, you need to get your own HST number. You can't use the HST number you previously had as a sole proprietor. A lot of people think it's just all the same thing because it's a business number. No, it's not. It's a separate entity. Even if your previous sole proprietorship was considered a business, really your corporation is a separate entity. It needs its own CRA business number and HST number. Okay. The corporate income tax payable would be due March 31st. So that's essentially coming up end of the month. And your corporate T2 income tax return will be due June 30th. Okay. So just a couple of points I just want to quickly mention about PREC realtors. If you are in the mode of saying, okay, I need to start getting my taxes together, maybe I'll wait a month or two. No, start now. Now is a great time, whether you have to do a whole bunch of catch-up reconciliation work, or you need to find an accountant that can help you with this. Reach out to people now. Don't be relying on accountants to file things, like essentially do a whole year of the corporate catch-up the week prior to things being due. Most people will not take on this service, or if they do it, they're not going to do a good job. So just be proactive about it. Start looking now. And with also finding an accountant, if you need help with bookkeeping, also try to find a competent bookkeeper well versed in corporation bookkeeping. Sometimes when we speak to our clients, they sometimes say, well, I know a bookkeeper, but they don't deal with corporations. Well, if you have a PREC, you're going to need someone that deals with corporations as well. Okay. And as I noted before, the processes for filing is different than a sole proprietor. But what's interesting is that the expenses that we listed for sole proprietors, those are still applicable for PRECs as well. So essentially, having a corporation doesn't allow you to claim more things. It's essentially the same things. The main thing that the corporation adds is tax deferral. So feel free to check out our website to learn about the monthly bookkeeping service we offer in case you are looking for someone to help you with your books along with your tax filings. Okay, Neal, do you want to discuss this slide?
Yes. So the most common question we get from realtors is, should they incorporate a PREC or not? We get this question like 100 times a day. Okay. So the answer really depends on each individual situation. It's not a black or white yes or no answer. A lot of people think, well, if my income is above 150,000, I need a PREC. And if my income is $1 below 150,000, I don't need a PREC. That is very inaccurate. It really depends on a lot of different things. So, for example, what is your income? That is the first question we need to know. But the really important question here is, what are your personal living expenses? Meaning, if you're making more money than you need for personal use, the PREC might be beneficial for you. Because let's say your income is $150,000, but you only need $75,000 a year for your personal living budget, and that extra $75,000 is just going to go to savings, in such a case, the PREC could be very beneficial, because the tax rate in the PREC is only 12.2%, whereas the personal tax rates are way higher. Stephen, if you just go to the next slide, I've listed here the personal tax rates in Canada. These are very high tax rates, especially once you get into those above 98,000. Between 98 and 150, you pay 43%. Between 150 and 220, 48%. And above 220, 53%. So these are the this is Ontario tax rates, federal and provincial income tax combined. So once you do hit above 100,000, you do want to start thinking about this question. Okay, and because the PREC tax rate is only 12.2%, if you ask anybody, anyone off the street, hey, would you rather pay 12% tax or 53% tax? They're going to say 12%. So if we go back to the previous slide for a minute, the general rule of thumb here is there's two rules of thumb. One, if you're making more money than you need for personal use, the PREC might really be a great idea. But on the other hand, if you need every dollar of commission income that you're earning for personal use, then the PREC might not really provide any tax advantage. Okay, so that's how you have to think about it. So in this question, you have to think about, have I maxed out my TFSA, RSP? Do I already own a principal residence? Or am I still trying to pay down other personal debts and lines of credit? Because if you need all your income for personal use because you want to max out your TFSA, or you need a down payment for your principal residence, then I don't know if the PREC would be such a good idea, because any money coming into the PREC, you'd have to take right out for personal use, and you have to pay yourself salary dividend, and then you pay the personal tax anyways. But if you've already maxed out your TFSA and you already own your principal residence, if you have no other debt personally, then the PREC could be very beneficial. So this is kind of how we think about this question. You have to get a consultation with a good tax advisor, call your accountant, or we do free consultations, and we ask you all these kinds of questions. We need to know your whole family's personal finance situation, and then we could come up with a good plan and determine if the PREC is beneficial for you or not. I'd like to now discuss the most important tax tips for realtors, and this tip actually applies really to any Canadian who's self-employed, whether in a corporation or a sole proprietor, but it's especially relevant to realtors because every commission check, every commission deposit that comes into your bank account, remember, you're collecting HST. So what we tell every single client of ours is set aside your HST. And I remember when I was a kid, I was a 90s kid, the 1990s, the best decade to grow up in. Set it and forget it. Remember those infomercials with that crazy guy with that rotisserie oven? Set it and forget it. That's what you do with your HST. It comes into your bank account. Open a savings account. Doesn't cost you anything. The bank will even pay you a tiny, minuscule bit of interest, okay? And you take the HST that comes into your checking account from each commission, put it into your savings account. It's set aside, so when you need to pay your HST installments or at the end of the year, it's there. Don't use that money. It's not your money, okay? You're a tax collector for the government. The government doesn't pay you for this tax collecting service that you're providing them, but you have to set it aside. And even income tax as well. We tell our clients, especially the higher income clients, your commission, aside from the HST, forget about HST, but you still have to pay income tax on the commission. So we say maybe from your commission income, set aside 10 to 20, 30%, depending. We do those estimates for clients. How much should they set aside? But this is very important. If you could just implement this one tax tip right away, you'll be in a much better situation because you won't be scrambling at year end. Oh, I owe $20,000 of HST. I didn't set it aside. That's a big problem because then you fall behind and you can never catch up. So this is very important. Set it and forget it.
Thank you, Neal. So I'm just going to quickly go over top 8 tax tips to implement. And as Neal just said, set aside income tax and HST. Second thing is monthly bookkeeping. Make sure you do keep all your receipts. You have a system to do it monthly. So again, for sole proprietors, this will be tracking HST, revenue, and expenses. If you have a PREC, the bookkeeping is even more important because you need to track HST, revenue, expenses, do your bank recs and your credit card recs, track your shareholder draws for those reasons we discussed earlier. Third thing, contact your accountant mid-year or start of year to do preemptive tax planning. especially if you are a PREC, you want to do this. Even if you're not a PREC and you're indicating saying, well, I'm paying over 40% tax, should I incorporate? This is something that you can talk to your accountant even like now. You don't have to wait till, let's say, November of this year to start having that discussion. Fourth thing is, and this is really important, set up your CRA My Account online using your SIN number. So it's so often, especially realtors and, let's say just the public in general, they always want to get a copy of a notice of assessment. Sometimes the bank wants it for financing, sometimes another party wants it, or sometimes they're getting letters from CRA, they're not getting the mail, but they want to check online, but they want to see their RSP room, TFSA room, whole bunch of things. You can get the CRA. I don't want to say a lot of things are good at the CRA, but one thing that has been working out right, that's been pretty good so far, is their online services. So definitely check out, or definitely open up My Account with the CRA using your SIN number. And the same thing as the point number 5 here for your business. Set up CRA My Business Account, and that will give you access to your business. And by business, I mean either your PREC or your sole proprietorship, which is basically like your HST account. Your HST information along with balances due for corporation and payroll and stuff like that. Okay. Number 6, do not neglect TFSA, RRSP, or RESPs. These are very powerful tax savings vehicles. Sometimes if you are sole prop but don't want, basically you want to try to figure out a tax deferral system without setting up a PREC, RSPs can be very useful that way. Number 7, don't forget, this is a common point, not just for realtors, but just the public in general. When you are selling a principal residence, you must report that on Schedule 3 and also a form called T2091 on your personal tax return. So make sure that those do get reported. It's not that you have to claim income on it. It's not like you need to add the sale to your income potentially, but you do need to disclose it, and not disclosing it could result in penalties. So just make sure about that. And number 8, do not trigger a CRA audit. So what I mean by this is you got to make sure that your expenses that you're claiming are reasonable. If, let's just say, you're a realtor first year in and you have, let's say, commission income of $30,000 and meals and entertainment of $50,000, the CRA may kind of question and say, what is going on there? So, not to say that $50,000 in some circumstances could be justifiable. It really depends. But again, like having big numbers like that could trigger an audit. So even if you're claiming some big items, make sure you do have enough support to justify that you are doing those. Make sure that you have support to show that you are doing, that you're incurring those expenses in the result of business activities. Okay, Neal, do you want to discuss?
Yeah, sure. So just to conclude, we'll just tell you a bit about our firm and what we offer. We service both sole proprietor realtors and realtors who have a PREC. We offer a monthly bookkeeping service where we do everything. We use our favorite apps are QuickBooks Online, and there's another app called Dex, and we do the bookkeeping monthly. It's all virtual, paperless. You don't have to send us any receipts. We have a whole system. So we're completely 100% virtual online firm. There's no in-person meetings. And of course, we do all tax filings, personal, corporate, HST, T4, T5 salary dividend. We remind our clients when their taxes are due. And of course, we provide tax planning, tax minimization strategies. And our fees are fixed, agreed upon upfront, and we do monthly billing. So that's just very quick about our firm. And then you can stay in touch with us lots of different ways. You can email us, info@realtytax.ca, or email Stephen or I. Our emails are at the bottom of the slide. And we have a mailing list. We send an article once every week or once every 2 weeks. So you could subscribe to that on our website, realtytax.ca. We have a Facebook group, Tax Tips for Real Estate Agents, and we're also on Instagram, realtytax.ca. So lots of ways to stay in touch. And now I think we're just going to do a bit of question and answers.
Thank you so much, Stephen and Neal. That was super informative. Some of the questions that I have for you is, a lot of the time I love that you answer the questions about, PREC and who should, choose a PREC and if that's relevant for them. But one of the questions I have is because of a lot of our agents, they do have a partner who's working with them in the real estate business, and they may or may not have very similar transactions that they're working on. Maybe they co-list together. What is your comment or your advice for people who, should they both get a PREC, or should one get it depending on the earnings, or does the same concept still apply?
Yeah, so one thing I just want to first comment, and this is just as per what's in the Ontario regulation specifically. Other provinces may have different restrictions on this, but in Ontario, they do say that it's only really one realtor per PREC. And that would include direct or indirect ownership via, let's say you own the shares directly versus you have it via a holdco. At the end of the day, the controlling interest still must be by one realtor associated with that PREC. So that's the main thing to keep in mind. Now, the question is to say, okay, between the two realtors, how much are they each earning, right? Normally, if they're both usually able to defer quite a bit of taxes, and usually this happens when you typically are earning over, let's say, 100,000, or you have another income source to live off your personal living expenses. That applies to both of them. Then usually we actually have them have set up their own individual PRECs. That is totally fine. They can both get tax deferral. Only thing you just got to keep in mind is that each one still needs to deal with the compliance on each side. So that is okay. Even let's say husband and wife, in theory, again, even if it's ideal to have them both husband and wife in one corporation or one PREC, if they're both high income earning, you can still have them have their own PRECs. That is okay. But of course, again, if it's not justifiable, then you can have one business partner have the PREC, the other one can remain as a sole proprietor.
That's great. Awesome. Thanks for the information. That's super, a lot of the time for real estate agents, they're not aware of that, right? And often, especially for people that file their taxes together as a family, and then all of a sudden they become real estate agents and you're not quite sure if you are taking it independently or not. So that's great.
Yeah.
And
I'll just add to that. We have quite a few clients where they operate as a team. Sometimes it's a husband and wife. Sometimes it's just two business partners. And a lot of them, they each have their own PREC. And so the brokerage pays the commission income into each PREC individually, just like when they were sole proprietors, same idea. But then they share all their expenses. So each PREC records 50% of all their expenses. And that's perfectly fine. Like that's allowed. There's no issue with that. But like Steven said, each individual realtor has to have their own PREC. And you can have a team where one team member is a PREC, one team member is a sole proprietor, right? That's totally up to the discretion of each realtor.
That's great. Thank you. So the next question I have is, do you recommend real estate agents, particularly new ones, work with their bookkeeper right off the bat when they start in the industry?
I would say it depends on the person. Okay. So some people, like, it depends on the personality of the person. Some people are very organized and diligent, and they like keeping track of every expense and every number, and they should have been accountants. I've seen some realtors where they send us their spreadsheet. I'm like, whoa, can I hire you as an accountant to work for my realtors? And they're very diligent and organized, and they scan in every receipt, and they have a perfect system. So those kinds of people, honestly, if they feel they can do it themselves and they have time and they have a good system, then they should go ahead and do it themselves. But you have to know yourself. So if somebody's starting out as a new realtor and they know nothing about accounting and bookkeeping, and they've never done this before, and this is the first time in their life they're self-employed, they've always been an employee in a T4 slip, they've never had to do any bookkeeping before, and they don't know how to keep track of their expenses, I would recommend that they hire a bookkeeper and they get themselves set up on some type of system right away from the beginning, because they're going to owe tax at the end of the year and they're going to need that bookkeeping done eventually. So why delay it? Why wait? I think that everyone should have some type of, every realtor, they should be teaching this at Humber. When realtors go through the program, they should have a course, how to keep track of your bookkeeping and taxes. And Stephen and I should go and teach the course. But I think every single realtor, right when they start, should have a system in place for their bookkeeping and taxes. Whether that means they're doing it themselves or hiring a professional is up to the individual, but absolutely there should be some sort of system in place right from the beginning.
Yeah, what we usually find too, just to add to what Neal's saying, is that usually with the realtors that do say they are able to do their own bookkeeping, and sometimes they just say like, it's okay, I can handle it. As Neal said, we do get a few one-offs where they end up actually doing it really well, but we find the majority of the time, especially when we're talking about corporation bookkeeping, if you don't have that exposure, we find usually the work that's being done is insufficient. And I don't mean to discredit those who are actually able to do it. I'm not trying to say that. What I'm just saying is that usually there ends up being problems, right? So if you kind of have that like feeling saying, well, I'm going to try my best, but I probably don't know what I'm doing, then I would just say stop what you're doing, hire somebody to do it, and then that way one less thing you need to worry about. So
yeah, if a new realtor is starting out with a corporation, I would say absolutely don't even try and do it yourself. You need a bookkeeper with corporation bookkeeping experience or use a service like ours because corporation is so different. It's so much more complicated than sole proprietor. A sole proprietor probably could do it themselves. You just need to keep the list of expenses. But again, you have to be that kind of personality and you have to know what you're doing. And if you're in doubt, I would just say hire a professional to do it.
And the other common questions that I always get asked by real estate agents that I work with, that they always ask me is, hey, do you have a separate credit card that you're using? Does your, and I always recommend that they speak to a professional accountant to see how their financing works. But, a credit card statement isn't going to be the one that is, going to be viable when it comes to tax auditing if you were to get audited. So, but what happens, do you think it's helpful for people to stay organized with their credit card?
Yeah, so one thing I could say with that is that, of course, especially I would say even if you don't have a PREC, even if you are just a sole proprietor, me and Neil always recommend that you do have a separate credit card. Reason why is that for organization purposes, one thing that it becomes very messy is when you basically need to just determine, say, okay, what if out of all my expenses I need to pick up, which ones are business, right? The other thing too is that in the event of an audit, now keep in mind, for an audit, the credit cards alone aren't sufficient. You do need to show the supporting receipts, but usually the auditors will ask for copies of credit card statements. Given that people tend to spend things on their credit cards, some things that they may not want the rest of the world to see, what you can basically do is that stuff that's pertaining only to business, you can put that on your business credit card and provide that to the auditor in the event of a review. So that is something where we usually say it basically does two things. One of them is that it kind of keeps your personal life separate from CRA's view. Second thing is that it shows that you basically it keeps it allows you to keep yourself more organized and having all your expenses in one statement essentially. Now, when you have with PRECS, so what's interesting about that is that PRECS should also definitely be having their own credit card. Reason why is that if, let's just say you have a credit card where you're using for business and personal, and your PREC is paying down that credit card, that can create tax issues for the owner because essentially now you have a PREC that's paying down personal expenses, like taking a draw, as we discussed before, that results in either salary or dividend to the owner. So that's why we're just saying, just to make things cleaner, have a separate credit card, especially if you have a PREC.
No, that's great information. And what is one common mistake you think real estate agents make when it comes to accounting and tax preparation?
Answers.
I think
so many. I'm just kidding.
Yeah, we could be here all day. I would say, well, I would say one common mistake, and this is why it's the most important tax tip, is set it and forget it. They forget to set aside their HST or income tax. But another common mistake is that they think, and we just talked about this, but they think they can do their own bookkeeping, even though they're in a corporation. So like we've had clients come to us and they say, oh, I incorporated my personal real estate corporation in 2020 or 2021. I haven't done anything yet with it. And we're a year late. So, or they tried doing their own bookkeeping, didn't work, and they never got around to finding an accountant. Or the other mistake is they just open a corporation and they open the bank account, and they start using it, but they don't do any bookkeeping. So that's a mistake where they think, oh, I'll just wait, 3 years later, and then I'll catch up for 3 years. That's always like a very inefficient process. So I guess to summarize, I think the mistake is not having that system in place right from the beginning. Steve, I don't know, maybe you want to chime in.
Yeah, to add to what Neil's saying too, another common thing that we see is usually when it comes to HST stuff. So if, let's just say in the past they said I filed my own HST return, we usually find there's usually big errors that exist in there. Sometimes we've had situations where people have not filed their personal tax return, but they filed the HST returns, say they want to file them quarterly. And we usually find is when we're going through the details saying there's either missed HST collected, or they missed a whole bunch of HST input tax credits, which is basically like a refundable amount you can get off your HST. So things like that, usually we find there's a lot of HST errors, and hence it goes to show why CRA puts more of their audit efforts in HST than any other program like income tax or payroll. So that's another thing too, is usually HST and just bad bookkeeping as issues.
Yeah, thanks for the information. I highly agree with you, Neil, in terms of people, this having to be part of Humber real estate programs, information that they teach real estate agents is I sit with real estate agents who get their license and, they don't even talk about accounting. And I even ask them, hey, do you have your own accountant? Do you know all the things you can claim? And there are a lot of things that are, grayscale right now where I'm part of a virtual brokerage. I get to work from home. A lot of people are working from home due to the pandemic. And your car that you use now, you don't drive to work anymore, but if you're a real estate agent and if you transitioned your career, now you're going to be using it more often for work and you use it for personal reasons. And so, and a lot of your expenses now starting to blur. So in order for you to not just get that list of expenses you should be tracking, I think my advice I always tell real estate agents is get in touch with someone like you, who is a professional who actually specializes in real estate taxing to help you with your business, and do a free consultation. So with you, just understand their business. And so that you can help them out with just getting on the same page about, how to manage the finances for your business and not to be too late when it comes to tax season.
Yeah.
Sorry, I was going to say just another thing to keep in mind was when it comes to the real estate business itself, it really is not a complex system. What makes it complex is more of the compliance work that fortunately our government imposes on like every little person. So that is kind of what is the problem here. And the good thing with us is that because we've seen so much of it, not only in our past experience in our own firms, but even with Realty Tax now, all of the stuff that comes about, we're very familiar with it, and we have a lot of confidence going in with this with the clients that we accept.
There were two things I wanted to say you reminded me of. Number one, in terms of a mistake a lot of realtors make for the realtors who have a PREC, is they take money out of the PREC, they transfer to their personal bank account, and they totally forget and ignore the fact that personal withdrawals from the PREC, we have to record a salary or dividend, and they pay personal tax that has to be planned in advance, and a T4 and T5 has to be filed, and tax has to be paid. So for realtors who have a PREC, just remember, anytime you're going to withdraw money for personal use, there are tax consequences to that, and tax planning must be done. So that's a mistake we often see, and we try to be on top of our clients and create that tax plan every year so they have a plan in advance for whatever personal withdrawals they need for the year. The other thing I wanted to mention in terms of new realtors going through the program, or brand new realtors, or realtors in the past 1 or 2 years, on our website, we recently published a guide to tax for new realtors. There's no cost. You just go on their website, you'll see it, you download it. And there's some really good information there. A lot of what we talked about today, sole proprietors and PRECS and basic things and due dates and filing dates, and some great information there. So I think every new realtor should read through that guide. It's a pretty easy read. Hopefully it doesn't bore the person to death, but there's some great information there.
Plus some pictures here and there.
Yeah, there's pictures and graphics, so it's a fun read, but a lot of really important information there. So feel free to, it's realtytax.ca, and then you just scroll down a bit, you'll see download the free guide to tax for new realtors.
Amazing. I'll make sure to add it in the video in the description below too, if anybody wants to check it out. And I'll make sure to link it to your expense checklist that you had there, that you showed us today. That was super helpful. So the last question I have for you is, how often do you see real estate agents get audited?
It's hard to say. And I mean, because not to say that we have every realtor in all of Canada to make a population estimate, but I don't want to say as far as number, but I usually kind of see where the triggers usually end up being when it comes to who the ones that end up getting audited. Usually it comes from the ones more that are like basically behind with filings. So one common thing that happens is that, let's just say if a realtor filed, let's say in their first year, they showed, let's say, a lot of income, and let's just say after that they're not filing their tax returns. The problem is that the government does what we call arbitrary assessments or notional assessments. What that basically is that they come to an assessment based on what they think you earned. And usually the amount's way overstated for what they actually earned. And then they get this big amount saying you owe X amount. And what's interesting about it too is that CRA's letters actually, when it goes to the CRA collections, that is actually enforceable even if that number is not correct. So what this goes to show is that, of course, if you're in this situation, you want to be able to remedy that by basically actually filing a proper tax return showing the real income that you had, not CRA's number. but at the same time also dealing with any potential collection matters, as we've, the word freezing bank accounts is something that has been talked a lot about in the news recently, but the reality is that CRA does have the power to also freeze bank accounts. So you want to get, you want to be dealing with the situation sooner rather than later, just so you don't have like a life crisis, never mind a tax crisis. So just want to put it out there.
Yeah, that's great information. Awesome. Thanks so much for watching, everyone. If you like this video, give it a thumbs up, and I'll make sure to add Stephen and Neal's information in the description below. So you make sure you get in touch with them if you have any questions around taxing, tax accounting tips, as well as just general information about just financing and just to keep things organized. And for everyone that's watching, I highly recommend that you follow Real Estate Tips for Real Estate Agents. It's a Facebook group that Neal and Stephen run. It's amazing, tons of information on there. And I highly recommend that you get on their email list and go to the website. I'll make sure to add it in the description below so that you're getting up-to-date information. And honestly, to be honest, your content is so engaging. It's hilarious, especially if you're following them on Instagram. I highly check out their content just for even informational entertainment reasons. So I highly recommend you follow it. I'll definitely leave all the links in the description below. And make sure you hit the subscribe button to get more information like this. And if you have any questions for Neal or Stephen or anything to do with accounting, make sure you leave it in the comment section below and I'll make sure to get it to them. Thanks everyone for watching. Thank you so much, Stephen and Neal, for joining me. I really appreciate it. That was amazing, informative presentation.
Thank you. Thanks for having us. Thank you.
My pleasure. Thank you.